Are you looking for good value stocks that are currently close to their 52-week lows? Let's dive into the world of value investing, a strategy that Warren Buffett himself swears by. It's all about finding stocks that are undervalued, stocks that the market has overlooked. You see, the market can be emotional, swinging between fear and greed, and in these swings, opportunities are born. Now, one way to spot these undervalued stocks is by looking at their price relative to their 52-week low. That's the lowest price at which a stock has traded in the last year. When a stock is close to this low, it might suggest that it's undervalued. But remember, it's not a guarantee. It's a signal, a starting point for further analysis. Why is this 52-week low so significant, you ask? Well, it provides a reference point that helps investors understand the range in which a stock has traded in the recent past. If a stock is trading near its 52-week low, it could mean that the market has been pessimistic about the company's prospects, pushing the price down. But if you believe that this pessimism is unwarranted and that the company's fundamentals are strong, then this could be a golden opportunity to buy a good stock at a discount. But of course, investing isn't just about buying low, it's about buying value. A stock trading near its 52-week low could be a falling knife, ready to plunge even lower. Or it could be a hidden gem, undervalued and ready to rise. That's why it's crucial to look beyond the price and understand the company's strengths, its competitive position, its financial health, and its future prospects. So, are you ready to explore the realm of value investing and discover potential opportunities in the stock market? Great. Let's examine 5 stocks that are close to their 52-week lows and could potentially offer good value. First up, we have United Health Group, a company that's been showing some significant dips recently. This healthcare conglomerate has seen a 7.88% decrease over the past year, with a 12.58% decrease year to date. It seems the primary factors affecting its performance are the recent updates to Medicare Advantage payments. Now, it may seem concerning to see such a dip in a company like United Health Group, but let's put this into perspective. This is a company that has consistently demonstrated a solid historical performance. It's been a reliable player in the healthcare sector, and its robust financial metrics are hard to ignore. Let's delve a bit deeper. United Health Group's current price stands at $455.25, skirting close to its 52-week low of $445.68. But while some may see this as a red flag, value investors might see it as an opportunity. You see, value investing is all about finding diamonds in the rough, stocks that are undervalued and have the potential to increase in value over time. And United Health Group, despite recent dips, could very well be one of these diamonds. Why, you ask? Well, it comes down to the company's fundamentals. Despite the recent downturn, United Health Group maintains a solid financial footing. Its historical performance and robust financial metrics, strong revenue growth, high return on equity, and consistent dividend payouts paint a picture of a company that, while currently undervalued, has the potential to bounce back. Yes, the recent performance might give some investors pause, but it's worth remembering that every company has its ups and downs. What sets a good investment apart is its ability to weather these storms and come out stronger on the other side. And with its strong fundamentals, United Health Group might just be able to do that. Despite the current lows, United Health Group's strong fundamentals make it a stock worth considering. Next, we move on to Nike, a household name that's been facing some challenges. Nike, a global leader in sports apparel and equipment, has experienced a significant drop in its stock price, around 26.7% over the last year. This is partly due to increasing operational costs and revised sales projections, which have impacted the company's overall performance. But it's not all doom and gloom for the swoosh. Despite the recent downturn, Nike's strong brand remains an asset that cannot be overlooked. Nike has built a reputation for quality, innovation, and style over the years, and this brand equity could be a key driver for its recovery. The company's consistent dividend growth also paints a promising picture. For investors, dividends can serve as a steady income stream, providing a cushion during market downturns. Nike has shown a commitment to returning capital to its shareholders through regular and increasing dividends, which can be a positive sign for value investors. Nike's resilience in the face of adversity is another point worth noting. The company has faced numerous challenges in the past, but has always managed to bounce back thanks to its strategic initiatives and robust business model. However, It's important to remember that a recovery won't happen overnight. It requires time, patience, and a well-thought-out strategy. Nike seems to understand this as it continues to invest in key areas such as digital transformation and direct-to-consumer channels to drive future growth. In conclusion, while Nike's recent performance might raise some eyebrows, its strong brand and consistent dividend growth cannot be ignored. These factors suggest potential for a recovery, making Nike an interesting prospect for value investors who are willing to weather the storm. Nike's brand strength and consistent dividends suggest potential for recovery and value. Now, let's turn our attention to 3M Company, a stock that's been on a downward trajectory. This multinational conglomerate, known for its innovation in various sectors from healthcare to transportation, has seen its share of ups and downs in the market. Over the past year, 3M has faced a significant downturn, with a decline of 13.42%. This is not a minor blip on the radar. Instead, it's a part of a bigger picture that indicates a trend of declining performance. Notably, this decline has been compounded by significant legal challenges, adding another layer of complexity to the situation. 3M's struggles are not confined to the courtroom alone. The company's financial performance has also raised eyebrows. Declining profit margins have added to the list of concerns for those keeping a close eye on this stock. This is an important indicator of a company's financial health, and the current scenario suggests that 3M is in a tough spot. But it's not just about the declining profits. 3M has recently cut its dividends, a move that has inevitably raised questions about its potential for value. Dividends are a key aspect of a company's appeal to investors, especially those looking for stable returns. A cut in dividends is often interpreted as a sign of trouble, further adding to the growing list of red flags. But before you write off 3M completely, it's important to remember that the stock market is a complex beast. While the company is undoubtedly facing challenges, it's also possible that these obstacles could present opportunities. After all, the greater the risk, the greater the potential reward, right? However, caution is the operative word here. While 3M's current dividend yield may seem attractive, potential investors should be aware of the risks involved. The company's declining profit margins and other challenges suggest that the risks may outweigh the benefits. In conclusion, 3M presents a complex picture with potential risks that may outweigh its current dividend yield advantages. As always, it's crucial to conduct thorough research and consider multiple factors before making any investment decisions. Moving forward, let's look at Starbucks, a company with a strong market presence despite recent lows. Stepping into the world of caffeinated beverages, we find Starbucks, a brand synonymous with coffee worldwide. Currently, Starbucks is trading at around $87.62, just a penny above its 52-week low. Over the past year, the company has seen a decrease of roughly 15.4%, with market challenges and competitive pressures playing significant roles in this downward trend. Yet, it's important to remember the adage, pressure makes diamonds, and Starbucks is no stranger to pressure. The company operates in an intensely competitive market, jostling with rivals for market share while also navigating the unpredictable waters of global commodity prices. But despite these pressures, Starbucks has managed to maintain a strong market presence, thanks to its globally recognized brand and diverse product offerings. Starbucks has a rich history of performance which can't be ignored. The company's growth story is remarkable, expanding from a single store in Seattle to thousands of stores worldwide. This growth has been driven by a potent mix of product innovation, strategic expansion, and a relentless focus on customer experience. Let's not forget Starbucks' record of consistent dividend growth. The company has a history of regularly increasing its dividends, demonstrating its commitment to returning value to shareholders. This consistent increase in dividend payouts is a testament to Starbucks' financial strength and its ability to generate robust cash flows. In conclusion, while Starbucks is currently facing market challenges and competitive pressures, it's essential to look beyond the immediate horizon. The company's strong market presence, coupled with its history of performance and consistent dividend growth, paints a picture of resilience. So, while the current lows might seem concerning, they might also represent a potential opportunity. After all, it's during the lows that the seeds of future highs are often sown. Starbucks' strong market presence and historical performance suggest potential for growth and value. Finally, we have Walgreens Boots Alliance, a company that's been facing financial difficulties. This well-known pharmacy giant has seen a significant downturn in its fortunes, with a sharp decline of 47% over the past year. This can be attributed to a number of challenges, most notably a decrease in free cash flow and significant debt hurdles. The issues Walgreens is facing are not superficial. They are deeply embedded in the company's financial structure. The decrease in free cash flow is a clear sign of distress, as it limits the company's ability to invest in its growth, pay off its debts, and distribute dividends to its shareholders. Speaking of dividends, Walgreens recently took the drastic measure of cutting its dividends. This is a red flag for any investor, as it indicates a company's struggle to maintain its financial health. Adding to these concerns is the company's substantial debt load. High levels of debt can be manageable if a company has strong, reliable cash flows. However, with Walgreens decreasing free cash flow, this debt becomes a significant challenge, one that could potentially threaten the company's future. Now, let's not forget that investing is all about balancing risk and reward. While some might see Walgreens' current low price as an opportunity, it's essential to understand the risks involved. The company's financial difficulties and uncertain future performance make it a risky proposition. It's possible that Walgreens can turn things around. After all, it operates in a sector that's always in demand. However, the path to recovery may not be smooth, and it may take some time. In conclusion, Walgreens Boots Alliance is a company that's currently facing significant challenges. It's a situation that requires careful scrutiny and a cautious approach. Remember, not all investments that seem like bargains truly are. Sometimes they're cheap for a reason. Walgreens presents a cautionary tale with financial difficulties and uncertain future performance, making it a risky proposition. So there you have it, a look at 5 stocks currently close to their 52-week lows. Let's take a quick stroll down memory lane, recapping the key points covered for each stock. United Health Group, despite a near 8% decrease over the past year and a 12.5% decrease year-to-date, still shows promise due to its solid historical performance and robust financial metrics. The company's recent dips, primarily affected by changes to Medicare Advantage payments, might just be a temporary setback for this healthcare giant. As we sprinted over to Nike, we saw a significant drop of nearly 27% over the past year. Challenges such as increased operating costs and impacted sales projections have put a dent in its performance. But let's not forget Nike's strong brand and consistent dividend growth. These factors suggest potential for recovery in value, even amidst current turmoils. Next, we stuck around with the 3M company, with a major downturn of over 13% in the past year, compounded by significant legal challenges and a recent dividend cut. It seems the adhesive giant is in a sticky situation. The analysis advises caution, as 3M's declining profit margins and potential risks might just outweigh the current dividend yield advantages. Then we brewed up some insights on Starbucks. Despite a 15% decrease over the past year due to market challenges and competitive pressures, Starbucks' strong market presence and historical performance might just be the caffeine kick needed to stimulate growth. Its consistent increase in dividend payouts adds a sweetener to this potential investment. Finally, we filled our prescription with Walgreens Boots Alliance. The company has experienced a sharp decline of 47% over the past year and has recently cut dividends amid decreasing free cash flow and significant debt challenges. The prognosis for Walgreens' financial health is uncertain, and so the video advises caution for potential investors. But here's the thing. While these stocks are near their lows, they each present different risk-reward scenarios. United Health's strength lies in its historical performance. Nike's value is in its strong brand. 3M's situation calls for caution, while Starbucks' potential lies in its market presence and consistent dividend growth. Walgreens, on the other hand, shows signs of financial difficulties. It's like a kaleidoscope, really. Each turn presents a different picture, a different perspective. The same goes for these stocks. Each has its own story, its own set of challenges and opportunities. But always remember this: investing isn't a one-size-fits-all kind of deal. It's about finding the right fit for you, your financial goals, and your risk tolerance. It's about understanding the landscape, the ups and downs, and the twists and turns. It's about being informed, being prepared, and being patient. Remember, investing always involves risks. Make sure to do your own research and consider your financial situation and risk tolerance before making any investment decisions. And with that, we wrap up our exploration of these 5 stocks. Until next time, keep your eyes on the market and your mind on your money. Don't forget to leave a comment and please subscribe to our channel for more insightful stock analysis.